It's Friday, March 27th, 2026, and you're about to go on the markets. Baseball season kicked off. We had our opening day and, well, the other great American pastime, the market. We're going to look at the markets today. Oil, inflation, and tech sell-off might be three pitches the market just can't shake off. What adjustments might be made with midterm elections on deck? See the baseball? We're doing some baseball puns there. A look at S&P patterns in the last 75 years of midterm elections. All 7 of the Mag 7 stocks are down this year and below the S&P as a whole. We compare their era to prior bubbles across the decades. And the line that was crossed that confirms to Daren that the S&P is indeed in a downturn. Let's get started.
The stock market, the economy, your money. What's the latest and what could be next? Find out now with Fermata on the markets. Straightforward financial market updates for the brands of Fermata Advisors, Sonoma Wealth Advisors, Fermata 401k, and Fermata Tax. On the markets starts now.
As I said, my name is Dano Weir. I'm the marketing director. If you know our firm, you know these guys. If you're new to the firm, Darren Blonsky, Chris Sipes, they're the managing principals of Sonoma Wealth, private wealth arm of Fermata Advisors. Chris, I need some motivation. Give me some wisdom. Give me a quote to give me some perspective this week.
All right. Well, the thing is, I think we always have to keep in mind that our emotions are going to drive investment decisions. And you want to be aware of what emotions are affecting you at any one time. And those can be, if you think back, Dan, not that long ago when we were in the AI mania, how it felt like everybody could not wait to jump in, getting calls every day. How do I get in on AI? People kind of tripping over themselves to throw money into the market. Now we're at the opposite end of that, where it's like, boy, things don't look so good right now. We tend to like overcompensate in either direction. And so this quote from William Simon is really great. He says, I continue to believe, that's the next quote. This quote is about inflation, which we're starting to see more signs of inflation around the corner. And his quote says, I continue to believe that the American people have a love-hate relationship with inflation. They hate inflation, but love everything that causes it. And boy, that's the truth. There's a book on interest rates, and I'm blanking on the name of it. It'll come to me sometime during this show. But the guy says that everybody loves an early inflation because it kind of pushes a lot of things up, asset prices and such. But then it kind of starts to take hold and then rears its ugly head. And inflation is bad for asset prices because it pushes up interest rates, pushes up the cost of money. And so in the early parts, though, people tend to like it, especially politicians, because they're the biggest cause of inflation by spending more, running huge deficits, cutting taxes, all the things that we do to basically not keep up with our spending. Those things tend to contribute to inflation. And then, of course, wars generally are cause inflation. And here we are. So we'll see if this time is different, but at least for now, we've been talking about how a lot of the asset classes that benefit from inflation, like commodities, are showing signs of inflation, and things like interest rates are showing signs of anticipated inflation around the corner. So it's likely that the market is pricing in some more of that coming down the pike.
Chris, is that book the Margaret Kennedy book?
No.
Interest in inflation-free money?
It's not.
Okay.
I'll come back to it.
Okay.
Okay. So here's what I was talking about though when it comes to your emotions. And you sort of know when the market corrections hit certain points, Dan, because you're going to hear more and more Warren Buffett quotes. There's like a barometer. Like the more the market goes down, the more Buffett quotes come out. But I do think he is a useful person to look to, because a lot of his uh, biggest and best investments have come at times when everybody else was running for the doors. So his quote is, "The fact that people will be full of greed, fear, or folly is predictable. The sequence is not predictable."
He just sits around and thinks of stuff like this. I mean, he just
yes.
he's firing
So-
off. He's
Well,
firing
hey,
off.
to that point, Dan, Drunkenmiller, who's he's probably one of the most famous traders of all times.
Yes.
He has a quote he talks about. He's like, well, people ask him like, well, what do you do? And he's like, well, for the most part, I just sit around, think, and read.
Mm-hmm.
And I think Buffett probably kind of does something similar.
Yeah. Good insight here. Hard to tell where we're at in the moment.
Munger, one of Buffett's partner, he'd always talk about inverting, right? So instead of thinking about how do I do something really smart, how do I make the right move here, he would say, think to yourself, how do I not do something stupid? How do I make it so that I eliminate making a bad decision and doing something I'm going to regret later? And that's a lot of times much easier than trying to do something brilliant. Bezos saying, bet on what's not going to change rather than what is going to change. And so I think that when things look like they do now, which is unpredictable, and it feels as though our survival instincts start kicking in, hey, get me to safety. Think back to the prior times when things like this have happened. And what was the prudent approach, and what turned out to be the right way to approach these things. And most of the time, it's like Daren said, you want to think and read and make sure you're making a good decision, not acting out of fear or greed. So, okay, let's take a look at some of the prior oil shocks. And I think what we would say about the last couple weeks is that it's a very much seems like a panic type of sale. When you see kind of everything selling off, stocks, bonds, gold, everything, just kind of getting dumped at the same time, typically that's a panic. Now, those don't tend to last long, and they tend to even out, and then we get kind of back to approaching the markets in some sort of a logical way. Now, if you look, this is from JP Morgan, and they're saying, looking at all past episodes of oil spiking over 50%, over the following 12 months, equities tended to be up. And they pointing out these areas where the market was down 12 months later, which was 1974, the year 2000, and 2021. They say we do not see this to be a 1974, 2000, or 2022 backdrop. Now, who knows? That nobody knows what the future is going to be, but those were the three instances where the S&P was down 12 months later, and only one of those was a real significant down, which was the year 2000, the debt bubble bursting. So there's been many times where we've had these spikes in oil prices, and once the market kind of adjusts to it, it tends to get past it. All right, now this from Ryan Dietrich at Carson. He says, midterm years, I think we kind of forget that midterm years tend to be not great either. So this is all clouded by the war right now. But even if the war wasn't happening, midterm years tend to be volatile years in the 4-year presidential cycle. So he says, Ryan Dietrich says, midterm years tend to see the largest peak to trough pullbacks. That's the bad news. But the good news, off the midterm year low, stocks have never been lower a year later and up nearly 32% on average. So you see that peak to trough, that's like, you hit your high dollar mark, which people always anchor to. We all look at our portfolios and say, remember when it was X and now it's Y. That's the peak to trough. But then you see the returns off of that trough. And the challenging thing is that we never know when that turn happens. And that's why when you have a portfolio, you want to understand how it's performed in the past and be fine with it, because making adjustments on the fly is usually the wrong decision, because you're making decision under duress, or you're making decision out of a lot of greed. So you want to know how that portfolio is likely to fluctuate and be fine with it. So we're in the midst of, I think the S&P is down a little more than 8% right now, so not even technically a correction yet. And so there's been many times where that's been worse. As you can see here in midterm years, the peak to trough tends to be pretty steep, but then the returns a year out tend to be pretty good too.
And a good example to remember, if you're trying to have a recent example to say, but this time's different. This same time last year, we were going through the tariff exercise. And as that was happening, it's very similar to now, a panic, and everything's selling off, right?
Why is it always around spring break? That's what I want to know.
Exactly.
I mean,
Exactly.
Come on.
And so just think back to then, how you felt then, and how it seemed impossible that anything could ever go up again. And the S&P ended the year up. Gold ended the year up very much so last year, And so here we are again, almost the exact same scenario. Not the exact same scenario, but a similar panic, a similar time of year. I'm not saying that it will, but I'm just saying just recently, a year ago, it did.
So to that point, Dan, a year ago when we were going through this during spring break, I'm still bitter about that, but we were down when we panicked about the tariffs were going to end the world. 21% down was the bottom. If you bought the bottom, right now the bottom is 9.11%. So, we not shocking if we hit another 10% down, right? But absolutely, I think now looking back, anyone would agree, like, hey, hold the line, because these things bounce quick, especially with the way the politicians run things nowadays, which is very much the taco trade, as we talked about last week, or you guys did.
Yeah, that's true. I mean, the great JP Morgan chart that shows, the average pullback in the S&P is around 14. So we're not even there yet. And I think it's actually remarkable, given everything that's going on, that things are holding together to that degree. And so that gives you hope that, the market is seeing something that we're not. Maybe it is that taco trade, Daren, like you said, but it's seeing something that is positive. And anytime you're looking at things and thinking, hey, the market is wrong, most of the time it's you that's wrong. And I'm, myself included. And so you have to really give credence to what that market is saying, the hive mind. So, all right.
To your point real quick, Chris, if you like to invest and you're not spending half the time arguing with yourself about why you're wrong, you're absolutely wrong.
Yeah.
It sounds kind of crazy, but like, so few people actually step back and try to argue in their own mind, like, here's why I'm wrong, and here's why my outlook is absolutely not correct. But that process is absolutely critical for successful investing.
Yeah. Just to riff on that for a second, talking before the show about managed futures, last spring, managed futures, which is trend following, was absolutely getting crushed. Imagine, the new administration coming in, and if you pretty much the worst type of investment strategy you could have picked coming into that administration was trend following, right? Because the trends just got blown to pieces, right? And about this time last year, you're looking at those in your portfolio and you're thinking, okay, it's just never going to work again. The investment, strategy is broken forever. It was in its I think it was in its largest drawdown, if not the largest, one of the largest drawdowns for trend following in history. And you just want to just get them out. I can't look at them anymore. Fast forward to this year, and most managed futures funds are doing great, trend following on commodities and currencies and such, and just having a great year so far. So usually, not every time, but usually when you're just that you just got to hold through, because usually it's the darkest before the dawn. Now, sentiment is bearish 49%, actually down a little bit, which I'm surprised off of last week. We're at 49%, but still pretty bearish. The bearish high was in April, almost a year ago. We were more bearish in last April about tariffs than we are right now about the war. That's interesting data point there. CNN Fear and Greed Index is at 17. Extreme fear, it's unchanged from last week. The Bitcoin Fear and Greed Index at 10. Extreme fear down from 23 last week. So sentiment is pretty poor at the moment. People feeling like things are pretty bleak. And then you look at consumer sentiment. Also, we got the new reading today, down at 53. Really, outside of recessions, you hardly ever see sentiment this low. Save maybe 2022 when the inflation was ripping. And so we've just been down here in the doldrums on a consumer sentiment standpoint and investor sentiment standpoint. Now, if you're a contrarian, when you look at this and you go, okay, eyes perk up a little. It's the old John Templeton said, you want to invest when there's blood in the streets. Don't think there's blood in the streets yet, but you get the idea of like, hey, a good time to invest is when everybody thinks it's the wrong time. So kind of full of investing quotes this week, guys, but it's one of those things where you look at the sentiment and you feel it on your own. You're like, ugh, not much to get excited about right now. And you have to take a step back and say, keep your perspective as an investor, and what this is likely to look, things are going to look like once we're past this. So
I have an aside to share just real quick, and I hope Daren enjoys this. So I on a marketing project for the firm, I was working with one of our advisors, Shelby, last week, and we were talking about a particular way we were going to do something. And so I was advocating for one way, and then I took a breath, and then I completely switched and advocated for the exact other way. And I laughed. And I said, I'm talking out of both sides of my mouth like Daren, which usually is an insult. Usually that's an insult, right, to say that. She's like, why would you say that? I was like, no, he says that he does that. And that's a perfect example of this, which is that, you're just like he said, are you able to talk yourself out of the logic? Are you able to, like, the decisions that you want to make? Are you able to, argue the other side so that you're not, because sometimes the way that you should actually be the exact opposite. Like you said, blood in the streets.
Absolutely. So now this is very interesting. Deutsche Bank came up with an index on when Trump might change his mind, the taco trade. And let me just read from Deutsche Bank here. Maximilian Ulier and his team at Deutsche Bank developed a simple and useful index of the pressure on the president, an equal weight measure composed of 4-week changes in the S&P 500, the 10-year Treasury, short-term inflation expectations, and the presidential approval rating. And they concluded with, the heat is on. Pressure is higher now than it was during Liberation Day. So this is interesting. Obviously, we've seen hints of changes and backing out and, this and that and the other thing. So, and you see the market kind of turn on a dime when those things happen. So you really can't be caught flat-footed here. And just like, the changes going in happen so quickly, they can happen just as quickly going out. And so this index, it would be interesting if this becomes even more handy as people people look at what's going to happen. Frankly, I think that's probably what the market is considering at this point, and the reason why things are not down more than they might otherwise be is that they expect a quick resolution and a change.
To that point, Chris, let me jump in there for a sec. What's different? Can you go back one slide? Between right now, like if you look at this index, right, and Liberation Day, tariffs delayed, Trump had all the control then, right? And I think whether Trump or his people might have underestimated is, I was reading some articles this morning, that if you kill all of the people who run a regime in a country, because literally they're on to the third level of regime leaders right now, you kill them all. If you want to just stop fighting because the market's getting too bad, or the oil's gone up too much, or interest rates are gone up, who do you talk with? Because if you look at how Iran set up their military, it functions with 31 different separate entities. Effectively, they planned for this day that when the Ayatollah and all his people would get killed, then each of the different jurisdictions, like our counties in the United States, would just function militaristically. So now you have to go through each one of these. They all have ballistic missiles. They all have people in charge. They all have drones. And you got to start taking all that out. Well, I mean, we've bombed. I think we've dropped something I saw the other day, something like 10,000 bombs now in Iran. I mean, that's crazy between us and Israel. It's a lot. And we're still probably not even close to doing everything we need to do to actually get it to calm down. And then if you've killed all the leadership in a country, and I'm not saying we shouldn't have or should have, I'm just saying here's the reality of it. If you kill all the leadership in a country, it turns into a lawless state, right? So then you have all these factions. So you got the Kurds and the Pakistanis and the Afghanistan, and you've got ISIS and ISIS-K coming in and start trying to claim different parts of the territory of Iran. It turns into lawlessness. So this idea that we could just go in there, kill a bunch of people, and then just stop the fighting because now midterms is going to come up or oil spiked too much and rates are going too high, I think is way too much credit. It's kind of my issue with conspiracy theorists, right? Like it's the issue with conspiracy theorists is if you give way too much credit for the ability of any one group of powerful people to control all the different variables that happen in life. It just it doesn't make sense. And so I think in this scenario, like we have definitely done some damage, and I wonder if, putting the genie back in the bottle might be a little bit more difficult than perhaps even Trump thought it was going to be at this point. And I think the chart might be saying that. And I'm going to show you in my section why I think that. But it's still very interesting nonetheless. And we're here for it.
And Daren, the way that you described that, I'll make this quick, but the way that you just described that whole scenario reminds me of a wildfire, which is when the wildfires happened in Sonoma County. I was working in radio, and I went through 2017 and didn't go out into them. In 2019, they came back, and I was like, I need to see this. And so I actually went as a wildfire reporter. I didn't know what I expected, but in my mind, I just expected, like, there's this wall of fire, right? And it's like us versus this wall of fire, and we're just trying to push back the line. And it's in a nice, neat circular shape, and we're just trying to push it all back. And when we actually went out into the hot zone, I'm like, where's the fire? We're driving through acres and acres of nothing. And what it really was these very diffuse, like, this is on fire, that's not. And that's on fire, and that's not. And it's asymmetric. So how you're describing the Iran situation is very similar in that it's not just like, oh, there's where the bad guys are, let's go have a fight at the one line. Like, this thing is all over the place, and there's many layers. It's not as simple as, okay, we're done.
Well, and so to your point, to use your analogy, that I think feels realistic to me is there's two instances in life where, like, I can really say for sure, like, you can feel the presence of something way more powerful than the human. And that's standing in front of the really, like North Shore, Hawaii during the winter waves that are just massive and just rocking you. And then you realize just like how not so powerful you are as a human. Like you just get absolutely destroyed. And I remember in high school, I'm like, oh, I can swim in these things. And I went in and just got absolutely pummeled. And there was just nothing I could do. And then the other instance I had was when I was fighting fire. And I remember this one fire is called the Trout Fire, which was in the Mendocino National Forest. And we were cutting line up this ridge. And in the Mendocino National Forest, the winds shift around 3 or 4 in the afternoon. And then it's related to the fog pulling in and out from the ocean. And when it switches from a downhill draft to an updraft, the fire is going to blow up. That's why you always see fires kind of blow up, because the fuel moisture goes down and then the winds shift in the evening. And that's what creates around here these really violent fire episodes. So you literally could be doing what you're doing, Dan, which is walking around the fire saying, where's the fire? Oh, there's some smolder here, smolder here. And then in 5 minutes later, there's this massive wall of flame. And I'll never forget, I'm sitting on this ridge watching this fire just literally just rip the bark off trees, just straight, just gut them. And I just sat there, and the only thing that was protecting me was the way the winds were shifted. The winds had shifted just slightly different. I would have been completely toast, and there was not a thing we could do about it, because we got caught off guard with the way the winds were in that area. And that was another moment where you felt your mortality in front of your face. And I think there's something to that, where when you unleash chaos in the world, you just go start killing all the leaders, good or bad, right? I mean, that's the argument why you keep a Kim Jong-un in place. For as awful as he is, you don't know what's behind him, right? And if you just start killing everybody, you literally have no one to negotiate with. And now you have 31 districts that are just blowing off missiles everywhere. And how are you going to put that genie back in the bottle? You're not. And I think that's what the market's saying. And I think what the market's saying is, we don't believe anything coming out of Trump's mouth anymore, because we don't think this is in control anymore. And I think that's what's starting to go through. But given what we've been through in the past 10 years with COVID and tariffs, all the things, like, I never underestimate the power to taco trade this thing. So you never want to be on the wrong side of it.
All right, sorry, Chris. We took a real left turn there. But Daren and I got going on our story. You know, we like our stories. Okay, we're having coffee, and I like our stories.
Yes. Okay. Now, we talked a little bit about stocks. We talked about sentiment. Let's talk about interest rates. And this from Bloomberg and Deutsche Bank. Deutsche Bank looked at the 10-year yield during previous sudden oil shocks. This is 1973, 79, 1990, 2022. On average, the yield was up 1% after 220 days. It's up about 42 basis points since February 28th. And this chart was from a few days ago, so it's a little bit stale. But essentially, you can see in past oil shocks that has sent interest rates up. Why? Because fixed income investors, when you're buying a bond or fixed income instrument, you're wanting to get a return on that money, and you have to factor in the value of your money over time. And if inflation is going up, you require a higher return to compensate you for that inflation. And so wars generally are inflationary, and fixed income markets know that. And so we would expect to see, if this continues, we'd expect to see interest rates continue to climb, making the cost of money more expensive. Now, you can see the average, which is the dark blue line, and then the red line, which is where we're at today. And, kind of where we are in terms of the days after the oil shock. So what's interesting too, with this oil shock, we were coming into it with interest rates going down. I think we got just under 4 on the 10-year right before this happened. So I think it jinxed myself. I was in touch with my mortgage consultant saying, "Hey, we got rates going. We got rates going down here, huh?" No. But if you look at high yield spreads, so this is another part of the fixed income market, the more what you would call kind of the riskier part of the high yield market. So this is lending to companies that have not the greatest credit. This is the spread over treasuries. And you can see that this is a 5-year chart. And typically when you get stress in the market, people are going to require a higher return to lend to companies that are poor credit quality. So that spread is only at 199 and call it 2%, which, as you can see, is not really that high relative to the historical norms. So at least so far, markets are not pricing in a major shock here in the credit markets. Now, the VIX, I think we'll look at when we look at the charts with Daren, a little over 30 is elevated. So that's the volatility index in the stock market, and definitely the volatility in the bond market is headed up. But in terms of the pricing of that credit, at least so far, we're not seeing the huge impact yet. Now, equities perform well in around half of the stagflationary environments, worse than other environments, but they should not be ruled out. So equities or stocks, they like low inflation and low growth, or low inflation and high growth. Essentially, stocks don't like inflation, but if we do end up getting high inflation, it's not like the returns of equities are horrible. It's just they're not as good. And so inflation, it tends to be a bad thing, bad environment for fixed income, especially a fixed income that is not inflation protected. But for equities, at least, it's not a great environment, but it tends to, over the longer term, not be a horrible environment like it is for bonds. Now, we may, if you're looking at, hey, chaos creates opportunities, dislocations create opportunities, we may be seeing a continued shift in the market, because despite this turmoil, the small caps in the US at least have held up better than the large caps. And we talked about all that time where the AI, mania was happening, that the large caps were getting very expensive, very concentrated. Everybody just was kind of leaving the small caps for dead. Small cap stocks went basically nowhere for about 5 years since the run up in 21. They were just sideways. And this is from Toby Carlisle. He says, over the last century, the smallest stocks, green, have beaten the biggest stocks, which are in the red, by 6 times, but not in a straight line. The market has cycled, and the cycles were long. The blue line shows the small versus big market cycles. When the blue line rises, smalls win. When the blue line falls, the biggest win. The second chart, which we don't have here, shows the relative sizes of the biggest and smallest stocks. So we have just passed the most extreme levels in the last century. Today's ratio is still near all-time highs, exceeding the late 1990s dot-com bubble and the early 2020s meme stock bubble. So if you're looking at places where it's like the historical relationships are pretty stretched, the rubber band is very stretched, I would say this is one area to keep an eye on over the longer term. Okay, and last one here. We did talk about the valuations being elevated in the mags, but relative to other historical bubbles, they're pretty tame. So the mags is in the top left, and if you look at the market weight at 35% and the 24-month forward price to earnings ratio at 26.8, seems pretty paltry to some of these others. The Japanese bubble in 1989 reached a price to earnings ratio of 67. Famously, their CAPE reached almost 100, their cyclically adjusted price to earnings ratio. Ours was at 40 at the peak here in the US in the dot-com bubble. We look at the tech bubble leaders in 2000, the forward PE was 52. So literally twice what that PE was in the mags most recently. And then the Nifty 50 back in 1973, all great companies, some of them still around, some of them not. At the time, Kodak was one of the best, fastest growers in the country, had a forward PE of 43. Does Kodak still exist? I'm not even sure. I don't think it does.
I think the only thing that exists for Kodak is its patents, and there's like a holding company that just gets paid all their patents.
Interesting. Sears, of course, that one's gone the way of the dodo bird. But 3M, Procter and Gamble, IBM still around. But anyway, their price to earnings ratio got up to 34. But an interesting little tidbit here from the Idea Farm. They say the Nifty 50 fell 60% from the peak and then lagged the markets by more than 30% from 1973 to 1977. So, if you're looking at the equities and going, gosh, I'm not super comfortable holding things that are expensive, and were expensive coming into this, you might look at equities that had a little more reasonable relative values. And if you're going to fall out of a building, it's better to fall out of the first floor than the 10th floor in terms of valuation. So
AI says Kodak is still in business. Despite recent financial warnings, company has stated it's not going out of business, remains operational, continues to produce motion picture and still film. So
now ask how much of its revenue comes from its patents versus actually producing a meaningful product.
Let me do that. How much of its revenue comes from patents? What do you got, Gemini?
I guess they could be like producing film for movies, but I would imagine that's digital now.
30%. So like the movies that are trying to go for Best Picture are still doing film, but yes, you're correct. The majority are doing digital. It says 30% of their revenue comes from patents.
30%.
Yep.
Wow. Well, so I guess that it's more of a viable company than I thought, but still 30% is pretty rough.
All right, so we've been talking about oil and inflation during Chris's slides. We've got a little bit of a baseball theme celebrating opening day. The third leg, the third strike potentially could be a tech sell-off. So, Daren, let's go on the markets. Let's look at the charts and see what exactly did sell off this week.
Wow, there's so many things I could show you this week. Let's do this first, and that's quiet the charts down because I think it's kind of overwhelming. So let me get rid of a bunch of these indicators here, and then I'll go back to them because I do want to cover them today. So I start using a different set of indicators when I'm trying to see where that bottoming behavior might be, where things might be basing out with the S&P 500. So you can see this. We're looking at the weekly chart. So this is the weekly SPY. So this is the largest 500 US based stocks. From a visual standpoint, it looks like this. Chris and I have for years now been talking about when these guys, big dogs, start selling, and it's pretty tough because there's such a concentrated position on the cap weighted index, right? The cap weighted index, it gives more credit to the bigger stocks than the smaller stocks. So what's happening is we're seeing these Mag 7 really sell off, and you can see Mag 7 had a rough week in the market. We actually broke below the high right here from this candlestick in 2024. And just a perfect example, like, when things are screaming high and everyone's portfolios are ripping and I'm making so much money in my mags or whatever, like this is the other side of the coin now, right? So if you look at our previous tariff correction from top to bottom here, that was 33% correction when we saw the megs do it last time. And right now we're looking at about an 19% correction from the high. So because these mags are selling off so heavily, there's not a lot the rest of the market can do to keep things up. And a different way to look at it is RSP, and even RSP looks pretty ugly at this point. But we haven't lost the 50-day moving average. So I'd be watching that green line on the RSP. We cut through that like a hot knife on butter today or this week on the cap weighted index, which is generally looked at is, the primary market. So where am I watching for support, right? So great, Daren. That's wonderful. Thanks for making us all feel good about our portfolios today. What am I watching for support? I'm watching this line right here, this high from February of 2025. I think that's an important one. Let's look at the daily chart to look at more information. And you can see there is a support zone right in this area here, right around 630 on the S&P. So then we start saying, okay, well, how oversold is this thing? Because maybe it's just oversold. So there's a couple of different indicators I like to look at. So the first thing actually we'll do before we add those indicators, I'm going to add volume in. So one of the things we want to look for is when we see a bottoming type of market, you tend to see a spike in volume. This trade from the 20th, like that's a pretty good look. You could start maybe making a case that that was the bottom. And I believe we talked about that last week. But then what happened this week is we traded up into that 200-day, and all week long, amongst all the advisors here at the firm, we were talking, oh, we're going to keep the 200. We're going to keep the 200. All eyes were on this blue line, this 200-day moving average, as some of the traders say, nothing good happens below the 200-day moving average. And that's where we're at. And we did get rejected this week. That rejection happened. And then Thursday, Friday, the market sold off significantly after that. And you can see, though, where it sold into was this range right here, where there's a lot of buyers hanging out and sellers, perhaps. So 6,300 is looking like a natural support level. Unfortunately, we didn't see a big spike in volume today, right? So if we had seen this really ugly candle come down and then a big spike in volume, I might start arguing like, hey, maybe that was the bottom. But the fact that we didn't see that doesn't make me feel like it is, that maybe we have further to go. I'd be watching 6,300 as a pretty important support area. So somewhere right around there next week, and some basing along that line. If we cut through that, I think there's a lot of buyers that step in around 6. At least we get some short-term support around 61 and change. And that's just because it's corresponding to this high here. So there's probably a lot of people with buys right there. So if we did trade down into that, it actually wouldn't be that shocking and would actually be fairly healthy for the market to correct to that point and then rebound upward. If we lose and go below that, like we've gone below that similar high here on the mags, and we went below that high, that's a little more concerning for me. There's a lot of support in this area. So the mags could still go down further, say call it 53 on this ETF that tracks that. There's support right in here in this 53, 54 zone, and we're not quite in there. But I would think there's buyers hanging out right in this area. So I'm definitely starting to look at, okay, where's the bottom? It's starting to feel oversold. And when you start to see things oversold, that can be an indicator. So one of the things we look at to help us understand oversold is something called Williams percentage, which is an indicator. It's a short timers indicator. A lot of traders use it, and it can usually tell you where there's a bottom. So you can see right here when we trade below this 80% line, you're looking at bottom formation, and sure enough, that was the bottom after the tariff thing. And we're down in that area. So we're definitely in the zone on the mags where we might be looking for a bottom. Let's look at what it looks like on the SPY, and you can see similar. This is a very sensitive indicator, so it's used for traders that are trying to, do quick trades in the market. And the other one that a lot of people look at to tell us if we're oversold is something called the relative strength index. And when we get below or at this 30 line here, then things are oversold. But you can see like we've dropped down pretty quick, pretty fast. So what we're looking for now to confirm we're going to bottom out in the next week is we're looking for volume. I want to see a volume bar like this right here. You can see that was that bottom where all the buyers stepped in. You can see buyers stepped in right on that mark there. Not always a perfect one, but when we assess all these different aspects of, we get a better picture of the market and understanding the probabilities. Because again, at the end of the day, it's all probabilities. On the side of we're not there yet, Bitcoin did break down. So that's that front end of the risk curve. And we are just bouncing along the bottom on the Williams, and we're down in the 30 round area for Bitcoin. So Bitcoin's that front end of the risk curve, but you can see it can stay in these areas for quite a while before it really rebuilds base and support, and then it takes off. So on the side of, hey, we still got more to go, I would put Bitcoin right now. Gold finally looks like it might be finding a little bit of a bottom here. We'll see. The fact that it went up so fast, though, like it's pretty hard to get too excited about much with gold. Let me can these guys because it just puts too much complexity on the charts. All right, let's take a look at 10 years. So this is really the what I would, if there's a few things I'd be watching, it would definitely be the 10-year. Because this is telling us that there's more inflation in the system. The fact that we have this kind of shooting star pattern today tells you that's kind of a short-term topping type of candlestick right there. So I would imagine we'll see some corrections. So the mortgage folks might get a little bit of relief here. But the fact that we had this upward trend line and we had this descending triangle and we broke out, went above it. Wouldn't be shocking to see a test here, but oil would have to really get under control. And like I was saying, there's a lot of reasons for that not to get under control at this point. And it's a pretty big assumption on behalf of anybody at this point to think they understand how that war is going to play out. I think it's getting past the point of where there's really anyone in control. One thing that I always kind of watch for, and I had this professor at Davis when I was there as an undergrad, and he studied revolution. So he was a consultant on revolutions. And he said, the only way you can ever tell there's a real revolution is if all the intelligence papers become public, right? If the intelligence papers don't become public, it's not a true revolution. And so we haven't seen anything like that happening, right? We're certainly killing lots of leadership in Iran, but I think we're far from that. I think the US and Israel trying to figure out who their puppet can be. And I don't know they've found that person yet. Actually, the guy they killed last week, who is, I think Lauren Johnny's his name, was supposedly one of the people they were vetting to be the next dictator puppet for Iran, but he, I guess, didn't pass, so they dropped a bomb on him. Anyway, I don't mean to make light of that awful situation, but that's effectively what's going on. So all eyes on oil, and you can see this big, huge candlestick came up today in oil. Oil just shot up. Market saying, nah, we don't really think this is going to calm down. Looked like we had this double top forming, but it's not looking like that pattern's going to follow through. It came down into neckline. It held, and it's pushing up still. So it is Friday. It's 2:30 Pacific. I guess we'll see what's going to happen now, because it seems like all the big stuff that happens is after the market closes on Friday. So that's oil. We've done Bitcoin. We talked about gold. Looks like it's catching a bid or support right here on this line. VIX is elevated. The fact that it closed above 31 tells us we got a definite build going on. And that's where I said earlier in the show, where this looks different to me from like the tariff panic we saw in 25. It's just like this lot of volatility really quick, but not a lot of build-up basing to that volatility, and then it calms down really quick. But the fact that we've had a lot of build in volatility, that's making me feel like this could go longer than certainly the politicians want it to. And the fact that when we look at the weekly chart now, like this is a pretty clear rollover and change in direction for the markets. At least in the short term, you have to argue that market is correcting. It's in a correction phase. Totally normal. Not suggesting anyone should freak out about their portfolio or anything like that. It's just markets go up, markets go down. And that's why we stay diversified. And that's what's happening. And I'm looking at this 604 range for support. There's also quite a bit of support here in the 620 range. So there's lots of areas we'd stop along the way, but it looks like a more structured sell-off than perhaps we saw during the tariff panic. And some of the other stuff we've seen where it was these big surprises of the market and then they calm down. This is certainly has a more of a build look to it, which at this point, I'm leaning more towards a 2022 type of correction where we have this slow trough in on some asset classes versus this COVID panic or this tariff panic. This looks more of like a build, a slow grind onto the asset classes. And I think because we've got interest rates that are high, we've got inflation that's still high. I don't think Mr. Welch coming in to run the Fed is going to have a very fun time running the Fed. He's got some hard decisions to be made, and especially when he's got the politicians pounding on him to effectively lower rates. So I wish I had better news. I don't necessarily have better news this week, but I do feel like, we are getting into the oversold territory. We can always get more oversold, just like we always tend to go up further than anyone thinks we will. We tend to go down further than anyone thinks we will, but there's a lot of support coming into the various asset classes. The thing that I don't know, and Chris, you probably feel the same, but boy, this change in bonds is just pretty drastic. And bonds continuing to correlate with stocks, which is frustrating for portfolio managers. And then when you look at the MOVE index, go ahead, Chris.
Well, one thing, luckily, you mentioned 2022, and probably anybody that held bonds during 22 is having, some PTSD, like, oh goodness, are we going back to that again? Well, you never know, but that was the worst bond market in history. And we went into that with interest rates very close to zero coming out of COVID. And they raised the rates. The Fed raised the rates to, 5% very quickly. Now, it's a totally different situation where we're at today with interest rates in the 5 to 6, 7% range, depending on what type of fixed income you're invested in. And so we're starting from there's more meat on the bone. There's more flesh that, there's more room for error is a good way to put it, because when interest rates go up, bond prices come down to account for that. And, but your starting interest rate makes a huge difference in how severe those drawdowns can be. So luckily we're in a totally different place for bonds today than we were then.
So this MOVE index, I think, this is what we watch, right? And clearly it's telling us there's something underneath the hood that isn't great, and that you see that building there. And to Chris's point earlier in the show where he talked about, these different indicators or this pressure on Trump, and you can see interest rates going up. There's a lot of pressure on Trump, but the fact that we haven't capitulated yet, and it doesn't seem to be that there's the ability just to now control the situation in the Middle East. I wonder if it's not beyond his control at this point. And we'll certainly see how the narrative gets shaped over the next few days. But overall, we're definitely in correction phase. It's happening. Doesn't mean you should do anything. It's just like, there's clouds in the sky. Some days it's cloudy, some days it's blue, and that's just the way life is. And if you keep diversified and stay the course of your strategy, you tend to do better in the long run. We'll leave it there.
Yeah, I think that's such an important point to make, Daren, which is that not to say we saw this coming, because you can never see anything coming really, but all three of us throughout 2025 were just continually astounded by the disconnection between price of a lot of tech stocks and earnings. And there was just more and more, it was nearing insanity, it was a fever pitch of like, this is all going to be everything. And to the point that like the peak has to be Sam Altman saying that he needs $1 trillion, federal backed to run his business.
Right.
Like, wow, man, you were feeling yourself. And so to us, I think all of us have seen a lot of these things. There had to be a moment where it came back down to earth. And that is why, we we tell it like it is. And that is why we preach diversity, Chris, is because, it helps offset things like this so that you're not sitting there going like, wow, why was I all in the Mag 7?
Yeah, exactly. And, unfortunately, diversification tends to work over time in the least exciting way, which is that it's not that it doesn't go down when stocks go down. It's just that it usually goes down less. And so you don't have to make up as much to get back to even. So like many things in life, it's not pain-free to get the thing that you want. There's still pain, just maybe not as much pain. And so it definitely doesn't do it in a way that you're like, wow, stocks are all down, several percent today and I'm up several percent. So that feels awesome. It's you're not hurt as badly. So it's a weird way how that works out.
Well, we'll leave it there. Will oil inflation and a tech sell-off lead to some changes at the midterm elections? We shall see. We appreciate you checking out the show this far, and we appreciate our clients very much. And if you're new to our firm, we are Sonoma Wealth Advisors. We're the private wealth arm of Fermata Advisors. You can learn more about us at sonomawealth.com. Wherever you found this show, whether it's on YouTube, Apple Podcasts, or Spotify, make sure you subscribe so you won't miss future episodes. You can also find additional podcasts, our sister podcast, It's All Money, with an amazing episode we just dropped last week about tax-aware investment strategies. Check that out. If you can't find it on our channels, you can also always find it at sonomawealth.com. We will see you next week, hopefully with better news.
You're up to date with Fermata on the markets. Learn about how the Fermata Advisors family of brands can help your family and business in finance. Sonoma Wealth Advisors, a comprehensive, holistic finance solution offering financial planning, asset management, and tax planning. Take our free wealth analysis now at sonomawealth.com. Fermata 401k, business retirement solutions for small and large companies with a fiduciary commitment. Learn more at fermata401k.com. Fermata Tax, personalized tax services for yourself, your family, or your business with an emphasis on efficiency. Find out how at fermatatax.com. If you haven't already, like and subscribe to Fermata on the Markets on YouTube, Spotify, and Apple Podcasts. Fermata on the Markets features human hosts, editors, and voiceover talent. Music by Dr. Delight on Soundstripe, voiceover by Joan Ellaway Nash. Thank you for listening to the very end. We appreciate diligent viewers and listeners. Fermata Advisors LLC is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempt from registration requirements. This content was produced by Fermata Advisors LLC, DBA Sonoma Wealth Advisors, DBA Fermata 401k, DBA Fermata Tax. The opinions expressed by Fermata Advisors LLC on this show are their own. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers and listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.